I need to tell you something that I have never shared publicly before. Over the past 18 months, I have been quietly accumulating positions in 3 artificial intelligence companies that I believe will define the next decade of technology. These are not the obvious names that everyone talks about. These are not the stocks that CNBC debates every morning. These are companies that most retail investors have never seriously considered, but that I believe represent the single greatest wealth-building opportunity of our generation. Now, before I reveal these 3 stocks, I need to explain why I am sharing this at all. I have spent over 20 years building technology companies. I understand this industry at a level that very few people do. I see what is happening behind the technologies being developed, the strategic moves being made, and what I am seeing right now in artificial intelligence is unlike anything I have witnessed in my entire career. We are at an inflection point. The decisions you make about AI investments in the next 12 to 24 months will determine your financial future for decades. Get this right, and you could build generational wealth. Get this wrong, and you will watch from the sidelines as others capture the greatest technology boom since the internet itself. Let me take you back to a conversation I had about 2 years ago that changed how I think about AI investing entirely. I was having dinner with one of the most respected venture capitalists in Silicon Valley, someone who has backed multiple billion-dollar companies and who has access to information that never reaches the public. We were discussing the AI landscape, and he said something that stopped me cold. He said that 90% of the money being invested in AI right now is going to the wrong companies. He said that investors are chasing the obvious plays, the companies with the biggest headlines, the flashiest announcements, but the real value, the companies that will actually capture most of the economic gains from AI, those are hiding in plain sight. They are not the companies building the AI models. They are the companies that make AI models possible. That conversation sent me down a research rabbit hole that lasted months. I talked to engineers, executives, researchers, and investors across the AI ecosystem. I studied the economics of how AI actually works. Not the marketing hype, but the nuts and bolts of what makes these systems function. And I emerged with a completely different view of where the real opportunities are. The conclusion I reached is counterintuitive, but I believe absolutely correct. The best AI investments are not the companies building chatbots and language models. The best AI investments are the companies that provide the essential infrastructure that every AI system depends on. The picks and shovels of the AI gold rush. Let me explain why this matters so much. Right now, there are hundreds of companies racing to build AI products. They are all competing to create the best chatbot, the best image generator, the best coding assistant, and many of them are doing impressive work. But here is the problem. They are all dependent on the same underlying infrastructure. They all need the same chips, the same cloud computing resources, the same data infrastructure. When you have hundreds of companies competing for the same customers, margins get compressed. Even the winners in the AI application layer will face brutal competition that limits their profitability. But the infrastructure companies, the ones that sell to all of those competitors, they capture value regardless of who wins the application race. This is the lesson of every major technology transition. During the California gold rush, most of the miners went broke. The people who got rich were the ones selling pickaxes and shovels. During the internet, boom, thousands of websites failed. The companies that built fortunes were the ones providing the infrastructure that all those websites needed. The same dynamic is playing out in AI. And once I understood this, The investment opportunities became crystal clear. Let me tell you about the first stock I've been quietly accumulating. The first company is Taiwan Semiconductor Manufacturing Company, which trades under the ticker TSM. And I believe this is the single most important company in the entire AI ecosystem. Yet most retail investors have never seriously considered it. Here is why Taiwan Semiconductor matters so much. Every advanced AI chip in the world is manufactured by this one company, every single one. When NVIDIA designs a new GPU, Taiwan Semiconductor makes it. When AMD creates a new processor, Taiwan Semiconductor makes it. When Apple develops a new chip for the iPhone, Taiwan Semiconductor makes it. When Google, Amazon, and Microsoft design custom AI chips for their data centers, Taiwan Semiconductor makes them all. This is not an exaggeration. Taiwan Semiconductor controls over 90% of the world's advanced chip manufacturing capacity. There is no second-place competitor that comes close. And building a competing facility takes a decade and costs over $100 billion, which means their dominance is likely to persist for many years. Now think about what this means for AI investing. Everyone is obsessed with NVIDIA, and their stock has had an incredible run. But NVIDIA does not actually make anything. They design chips. The actual manufacturing, the process that turns those designs into physical products, that is done entirely by Taiwan Semiconductor. When NVIDIA sells a chip for $10,000, a significant portion of that revenue flows directly to Taiwan Semiconductor. And as AI demand explodes, as every company in the world races to build AI infrastructure, all of that demand funnels through this single manufacturing bottleneck. Let me share some numbers that illustrate why I am so bullish. Taiwan Semiconductor's revenue from AI-related chips has grown over 300% in the past 2 years. Their advanced packaging technology, which is essential for high-performance AI chips, is sold out through 2026. They are building new facilities as fast as they can, but demand is growing even faster. The company just reported quarterly revenue of over $25 billion, with profit margins that would make most technology companies jealous. And they are returning massive amounts of cash to shareholders through dividends and buybacks. But here is what really excites me. Taiwan Semiconductor trades at a significant discount to the AI companies that depend on them. While NVIDIA trades at over 30 times revenue, Taiwan Semiconductor trades at around 8 times revenue. This valuation gap makes no sense to me. Taiwan Semiconductor is an essential monopoly supplier in the fastest growing technology market in history, and they are priced like a mature industrial company. Now I need to address the obvious concern, which is geopolitical risk. Taiwan Semiconductor is based in Taiwan, and the relationship between Taiwan and China is complicated. Many investors avoid the stock entirely because they worry about what would happen if China invaded Taiwan or if there was a major disruption to semiconductor supply. I take this risk seriously, but I also think it is often overstated. Here is my perspective. First, China invading Taiwan would be economically catastrophic for China itself. China depends heavily on chips manufactured in Taiwan. Destroying that manufacturing capacity would devastate Chinese industry and technology for decades. The economic self-interest argues strongly against military action. Second, Taiwan Semiconductor is actively diversifying their manufacturing footprint. They are building major facilities in Arizona, Japan, and Germany. Within 5 years, they will have significant manufacturing capacity outside of Taiwan, which reduces the geographic concentration risk. Third, the United States government has made semiconductor manufacturing a national security priority. The CHIPS Act is providing tens of billions of dollars in subsidies for domestic semiconductor production. Taiwan Semiconductor is one of the primary beneficiaries of this support. Fourth, and most importantly, the valuation already reflects significant geopolitical risk. Taiwan Semiconductor trades at a substantial discount to peers precisely because of these concerns. If the situation stabilizes or improves, there is significant upside just from multiple expansion before you even consider the underlying business growth. I have been accumulating Taiwan Semiconductor shares for over a year now. It is one of the largest positions in my personal investment portfolio, and I believe it offers the best risk-adjusted returns of any AI investment available today. Let me tell you about the second stock I have been buying. The second company is ASML, a Dutch company that trades under the ticker ASML. If Taiwan Semiconductor is the only company that can manufacture advanced chips, ASML is the only company that can make the machines that Taiwan Semiconductor uses. It is a monopoly built on top of a monopoly. Let me explain what ASML does, because most people have never heard of them, even though they might be the most important technology company in the world. Manufacturing advanced semiconductors requires a process called extreme ultraviolet lithography, or EUV. This is the technology that allows chip makers to print transistors that are just a few nanometers wide, smaller than a virus, thousands of times thinner than a human hair. Without EUV, you cannot make the advanced chips that power AI. ASML is the only company in the world that makes EUV machines, not the market leader. The only company, they have 100% market share. Every advanced chip manufactured anywhere in the world is made using ASML equipment. These machines are engineering marvels. They cost over $300 million each. They contain over 100,000 parts, including lasers that fire 50,000 times per second, mirrors that are the flattest surfaces ever created by humans, and optics so precise they could hit a golf ball on the moon from Earth. No other company has been able to replicate this technology despite decades of trying. Now here is what makes ASML so attractive as an investment. The demand for advanced chips is exploding because of AI. Every major cloud provider is racing to build AI infrastructure. Every large company is trying to deploy AI capabilities. Every country wants domestic chip manufacturing capability for national security reasons. All of this demand flows up the supply chain to ASML. But ASML can only make so many machines per year. Their production is constrained by the incredible complexity of their equipment. This creates a situation where demand far exceeds supply, which gives ASML enormous pricing power. Let me give you some numbers. ASML's backlog, the orders they have received but not yet fulfilled, is over 30 billion euros. That is nearly 2 years of revenue already contracted. Their customers are paying deposits years in advance just to secure a place in line. This is not a company that needs to worry about demand, and because there is no competition, ASML does not have to worry about pricing pressure. They can raise prices steadily while maintaining massive profit margins. Their gross margin is over 50%, which is extraordinary for a hardware company. The company is also phenomenally well managed. They invest heavily in research and development to maintain their technological lead. They return substantial cash to shareholders through dividends and buybacks. They have a balance sheet with minimal debt and significant cash reserves. ASML trades at a premium valuation around 30 times earnings. But I believe this premium is justified by their monopoly position, their growth trajectory, and the quality of their business. There are very few companies in the world with competitive positions this strong. Here is something else that most investors miss about ASML. Their equipment has a long lifespan, typically 20 years or more. This creates a massive installed base that generates recurring revenue from service contracts, upgrades, and spare parts. Even if chip demand temporarily slowed, ASML would continue generating substantial revenue from their existing customer base. I started buying ASML about 18 months ago, and I have continued adding to my position on any significant pullback. It is not a cheap stock by traditional metrics, but I believe the quality of the business justifies the valuation. And in a world where AI demand continues to grow, ASML's revenue and earnings will grow right along with it. Now let me tell you about the third stock, which I believe offers the most explosive upside potential of the three. The third company is ARM Holdings, which trades under the ticker ARM. This is a company that most retail investors have only recently become aware of, but which has quietly become one of the most strategically important technology companies in the world. ARM does something fundamentally different from the other companies I have mentioned. They do not manufacture chips like Taiwan Semiconductor. They do not make chip manufacturing equipment like ASML. Instead, they design the fundamental architecture that most chips are built on. They license this architecture to other companies who then create their own chips based on ARM's designs. Let me explain why this matters so much. There are two main chip architectures in the world. One is called x86, which was developed by Intel and is used in most traditional PCs and servers. The other is called ARM, and it is used in virtually every smartphone, most tablets, and an increasing share of data center processors. ARM's architecture has some fundamental advantages that make it particularly well suited for AI workloads. ARM chips are more power efficient, which matters enormously when you are running massive data centers that consume as much electricity as small cities. They are more flexible, allowing customers to customize designs for specific applications. And they are increasingly competitive on raw performance, which has historically been Intel's advantage. Here is what has happened over the past few years that makes ARM so exciting right now. Apple switched their Mac computers from Intel processors to custom chips built on ARM architecture. The results were stunning. The new Macs were faster, ran cooler, and had dramatically better battery life. This proved that ARM could compete at the highest performance levels, not just in mobile devices. Amazon has developed custom ARM-based processors for their AWS data centers called Graviton. These chips offer better price performance than traditional Intel processors, and AWS customers are rapidly adopting them. Microsoft and Google are following similar strategies with their own ARM-based data center chips. And perhaps most importantly, NVIDIA's next generation of AI chips for data centers will incorporate ARM architecture. NVIDIA paid $66 billion to try to acquire ARM before regulators blocked the deal. That tells you how valuable they believe ARM's technology is. Now here is what makes ARM's business model so powerful. ARM does not sell chips. They license their technology. Every time a company designs a chip using ARM architecture, ARM receives a licensing fee every time one of those chips is manufactured and sold. ARM receives a royalty. This creates a business model with incredible leverage. ARM does not have to build factories or manage supply chains or worry about inventory. They invest in research and development to improve their architecture, and then they collect royalties on every chip that uses it. The marginal cost of each additional chip sold is essentially zero, which means revenue growth flows almost entirely to profit. The numbers are remarkable. Over 250 billion chips using ARM architecture have been shipped in the past 3 decades. The company estimates that ARM-based chips are in over 70% of the world's population's devices. And the average royalty per chip has been increasing as ARM captures more value from higher-end designs. But here is what makes the current moment so exciting. AI is creating enormous new demand for ARM's technology. AI inference, the process of running trained AI models to generate outputs, is increasingly moving to edge devices, your smartphone, your car. They all need AI capabilities. And the most efficient way to deliver AI on these devices is through ARM-based processors optimized for AI workloads. ARM has developed new architecture specifically optimized for AI applications. Their latest designs include dedicated machine learning accelerators that dramatically improve AI performance while maintaining power efficiency. Every major smartphone chip, including Apple's and Qualcomm's, uses these AI-enhanced ARM designs. The data center opportunity is equally exciting. As cloud providers increasingly adopt ARM-based servers, and as AI workloads grow exponentially, ARM's data center royalties are growing at over 50% annually. This is still a small percentage of total revenue, but it represents enormous long-term potential. ARM went public in September of 2023 at $51 per S-share. The stock has been volatile since then, rising to over $150 before pulling back. This volatility has created opportunities to accumulate shares at attractive prices. I believe ARM is positioned to be one of the biggest beneficiaries of the AI revolution. They collect royalties on virtually every AI chip that is not made by Intel. As AI demand grows, as more devices incorporate AI capabilities, as data centers shift to ARM architecture, ARM's royalties will grow accordingly. The company has minimal capital requirements, generates substantial free cash flow, and has a long runway for growth. The main risk is valuation. ARM trades at a significant premium because the market recognizes its strategic importance. But I believe the growth potential justifies paying up for quality. Now let me step back and explain why these 3 stocks together form such a powerful AI investment portfolio. Taiwan Semiconductor, ASML, and ARM represent 3 different layers of the AI infrastructure stack. ASML makes the equipment that enables advanced chip manufacturing. Taiwan Semiconductor uses that equipment to manufacture the most advanced chips in the world. And ARM provides the architecture that an increasing share of those chips are built on. These companies are not competing with each other. They are complementary. They each benefit from the same underlying trend, which is explosive growth and demand for AI chips. But they capture value at different points in the supply chain, which provides diversification. More importantly, all 3 companies have what I consider the most valuable attribute in investing, which is durable competitive advantage. ASML has a monopoly on UV lithography. Taiwan Semiconductor has a near monopoly on advanced chip manufacturing. ARM has a dominant position in mobile and growing share in data centers. These positions are protected by technology that took decades and hundreds of billions of dollars to develop. Compare this to investing in AI application companies. Those companies face brutal competition. OpenAI competes with Google, Anthropic, Meta, and dozens of others. The winners will generate huge revenues, but the competition will compress margins. And if your AI application company loses the technology race, the stock could collapse. The infrastructure companies do not face this risk. They win regardless of which AI application company succeeds. They are the arms dealers in the AI wars, profiting no matter who is fighting. Let me also address the question of timing, because I know many people are wondering whether they have missed the opportunity. All three of these stocks have appreciated significantly over the past 2 years. Taiwan Semiconductor is up over 100% from its lows. ASML has roughly doubled. ARM has nearly tripled from its IPO price. It is natural to wonder if the easy gains have already been made. My view is that we are still in the early innings of the AI infrastructure build-out. Consider the numbers. Global spending on AI infrastructure was around $50 billion in 2023. Industry analysts expect it to reach over $300 billion annually by 2028. That is 6 times growth in 5 years. And I believe even these projections might be conservative given the pace of AI advancement. Every dollar of that spending flows through the semiconductor supply chain. Chips need to be manufactured by Taiwan Semiconductor. Those chips require equipment from ASML. Many of those chips will use ARM architecture. The demand growth for these companies is not speculation. It is contracted in the form of orders and backlogs that stretch years into the future. Yes, the stocks have run up, but the underlying businesses are growing faster than the stock prices would suggest. Taiwan Semiconductor's forward earnings multiple has actually compressed over the past year because earnings growth has outpaced stock price appreciation. The stocks may be higher in absolute terms, but they are not necessarily more expensive relative to fundamentals. I am continuing to accumulate all three positions. I add on any significant pullback, and I hold through volatility. My time horizon is not months, but years. I believe these companies will be worth multiples of their current value by the end of the decade. Now let me share some thoughts on position sizing and portfolio construction, because I think this is important for anyone considering these investments. I have allocated a significant percentage of my investable assets to these three stocks. The exact percentage I will not disclose, but it is substantial. I believe the opportunity is large enough and the probability of success is high enough to justify meaningful positions. However, I recognize that my risk tolerance and financial situation are different from most people. I can afford to take concentrated positions because I have other resources to fall back on for most investors. I would suggest a more balanced approach. A reasonable allocation might be 5 to 10% of your portfolio in each of these stocks, for a total of 15 to 30% in AI infrastructure. This provides meaningful exposure to the opportunity while maintaining diversification across other sectors and asset classes. I would also suggest dollar cost averaging rather than investing everything at once. These stocks can be volatile, and buying over time reduces the risk of investing at a temporary peak. Regular purchases over 6 to 12 months smooth out entry prices and provide the discipline to keep investing through market fluctuations. Finally, I would emphasize the importance of patience. These are not short-term trades. They are long-term investments in companies that I believe will compound value for many years. There will be pullbacks, there will be quarters where results disappoint. There will be moments when the market loses enthusiasm for AI stocks. None of that changes the underlying thesis. The investors who build wealth are the ones who identify great businesses, buy them at reasonable prices, and hold them through volatility. I believe Taiwan Semiconductor, ASML, and ARM are great businesses at prices that will look very reasonable in hindsight. The key is having the conviction to hold. Let me talk about the risks, because I think it is important to be clear-eyed about what could go wrong. The biggest risk across all three stocks is a slowdown in AI demand. If AI fails to deliver on its promise, if the technology hits fundamental limitations, if economic conditions cause companies to cut back on AI investments, all three stocks would suffer. I consider this risk relatively low given what I am seeing in actual AI adoption. But it is not zero for Taiwan Semiconductor specifically. Geopolitical risk remains the primary concern. I have explained why I believe this risk is manageable. But I acknowledge that a Taiwan conflict would be catastrophic for the stock. Investors need to be comfortable with this risk before taking a position. For ASML, the main risk is technology disruption. If someone developed an alternative to UV lithography, ASML's monopoly would be threatened. However, no viable alternative exists, and the technological barriers to entry are enormous. I consider this a low probability risk for ARM. The main risk is competition from alternative architectures. Intel is pushing hard to remain relevant in data centers. RISC-V, an open source architecture, is gaining traction in some applications. If ARM's architecture loses share, royalty growth would slow. However, ARM's ecosystem advantages are substantial and growing. There are also macro risks that affect all stocks. A severe recession would hurt technology spending. Rising interest rates reduce the present value of future cash flows. Currency movements affect international companies like these. These risks are real, but not unique to AI infrastructure stocks. On balance, I believe the potential rewards significantly outweigh the risks. These companies have dominant market positions, growing end markets, and strong balance sheets. They are exactly the type of investments that create generational wealth. Let me close with some thoughts on why this moment matters so much. We are living through one of the most significant technology transitions in human history. Artificial intelligence will transform every industry, every profession, every aspect of human life. The economic value created will be measured in trillions of dollars. Most of that value will be captured by a relatively small number of companies, the companies that build the essential infrastructure, the companies that are impossible to compete with, the companies that benefit regardless of which applications succeed. I have identified 3 such companies. Taiwan Semiconductor manufactures every advanced AI chip in the world. ASML makes the only machines that can produce those chips. ARM provides the architecture that an increasing share of chips are built on together. They form the foundation of the AI revolution. I have been quietly accumulating these stocks for over a year. I believe they represent the best risk-adjusted opportunity in the market today. And I am sharing this analysis because I believe individual investors deserve access to the same thinking that guides institutional allocations. The window of opportunity is not unlimited. As more investors recognize the value of AI infrastructure plays, prices will adjust. The time to build positions is now, while the opportunity remains. This is not about getting rich quick. This is about positioning yourself to benefit from a technology transition that will unfold over the next decade or longer. The investors who understand this, who have the patience to hold through volatility, who accumulate shares consistently over time, they will look back on this period as the moment that transformed their financial futures. I know what I am buying. I know why I am buying it. And I am more confident in these investments than anything else I own. That is not something I say lightly, and it is not something I would share unless I truly believed it. The AI revolution is happening. The infrastructure is being built, and the companies building it will generate returns that define a generation. I intend to be a shareholder when that happens, and I hope you will be too. Now, let me go deeper on each of these companies, because I think understanding the details is crucial to having the conviction to hold through volatility. Let me start with Taiwan Semiconductor and explain exactly how their business works, because most investors do not appreciate the complexity and the moat. Semiconductor manufacturing is not like other manufacturing. You cannot just build a factory, hire some workers, and start producing chips. The process requires technology that takes decades to develop, equipment that costs billions of dollars, and expertise that exists in only a handful of places in the world. Taiwan Semiconductor has been perfecting their manufacturing process for nearly 4 decades. They have invested hundreds of billions of dollars in research and development. They employ tens of thousands of engineers who have spent their careers mastering the intricacies of chip manufacturing. This accumulated knowledge and capability cannot be replicated quickly. Here is something that illustrates just how difficult this business is. Intel, one of the most storied technology companies in history, has been trying to catch up to Taiwan Semiconductor for over a decade. They have spent tens of billions of dollars, they have hired top talent, they have access to the same equipment from ASML that Taiwan Semiconductor uses. And they are still years behind Samsung. The Korean conglomerate with virtually unlimited resources has been trying to compete with Taiwan Semiconductor in advanced chip manufacturing. They have their own EUV machines from ASML. They have invested massively, and they still cannot match Taiwan Semiconductor's yields and reliability. This is the nature of Taiwan Semiconductor's moat. It is not protected by patents or contracts that can expire. It is protected by accumulated expertise that cannot be transferred or replicated. Every year that passes, as Taiwan Semiconductor moves to smaller and smaller process nodes, their lead extends. Let me explain what process nodes mean, because this is crucial to understanding the business. Semiconductors are made by printing transistors onto silicon wafers. The smaller you can make these transistors, the more you can fit on a chip, which means more processing power and better energy efficiency. The size of transistors is measured in nanometers, and the industry refers to different transistor sizes as process nodes. 10 years ago, state-of-the-art chips were made on 28 nanometer process nodes. Today, Taiwan Semiconductor is manufacturing chips at 3 nanometers, and they are developing 2 nanometer technology for production in 2025. For context, a human hair is about 70,000 nanometers wide. These transistors are almost impossibly small. Each new process node requires years of research and development and billions of dollars in capital investment. Taiwan Semiconductor spends over $30 billion annually on capital expenditure, most of which goes to developing and deploying new process nodes. This level of investment is only possible because of their scale and profitability. And here's the key point. Only Taiwan Semiconductor can manufacture chips at 3 nanometers in volume production. Samsung has struggled with yields at their advanced nodes. Intel is still working on catching up for the most demanding applications. Including AI chips, Taiwan Semiconductor is the only option. This gives them incredible pricing power. When NVIDIA or Apple or Qualcomm needs to manufacture their most advanced chips, they have nowhere else to go. They pay whatever Taiwan Semiconductor charges because the alternative is not having products to sell. Let me talk about the capacity situation because this is driving much of the investment thesis. Right now, demand for advanced chip manufacturing far exceeds supply. Taiwan Semiconductor's customers have placed orders that exceed their manufacturing capacity for the next 2 to 3 years. They are building new factories as fast as they can, but factories take 3 to 5 years to construct and equip. This supply-demand imbalance is incredibly favorable for Taiwan Semiconductor. They can be selective about which customers they prioritize, they can charge premium prices, they can require long-term commitments and advance payments. This is the best possible environment for the business. And the demand drivers are not temporary. AI requires enormous amounts of computing power. The training of large language models requires thousands of advanced GPUs running for months. The deployment of AI services requires data centers filled with AI accelerators. As AI applications expand into more areas of the economy, demand for AI chips will only grow. Beyond AI, there are other demand drivers that investors often overlook. The automotive industry is becoming increasingly computerized. Modern cars contain hundreds of chips controlling everything from engines to entertainment systems. Electric vehicles and autonomous driving require even more sophisticated semiconductors. The Internet of Things is connecting billions of devices that all need processors. Industrial automation is accelerating. Cloud computing continues to grow. 5G infrastructure requires advanced chips. All of these trends feed into demand for Taiwan Semiconductor's manufacturing services. Let me also discuss the financial characteristics that make Taiwan Semiconductor such an attractive investment. The company generates gross margins of over 50%, which is extraordinary for a manufacturing business. They convert a significant portion of revenue into free cash flow, which they use for capital investment, dividends, and share buybacks. Taiwan Semiconductor has raised their dividend every year for over 20 years. The current dividend yield is around 1.5%, which may not seem exciting, but it is growing at double-digit rates annually. Over time, this dividend growth compounds into substantial income. The balance sheet is rock solid. They have minimal debt relative to their cash generation. They have substantial cash reserves that provide flexibility. They have no financial stress that could force suboptimal decisions. Management has demonstrated excellent capital allocation over many years. They invest aggressively in technology leadership, which maintains their competitive advantage. They return excess cash to shareholders rather than empire building. They make decisions with long-term shareholder value in mind. Now let me expand on ASML because I think investors underestimate just how extraordinary this company is. ASML's monopoly on UV lithography is one of the most durable competitive advantages in the technology industry. No other company has this technology. No other company is close to having this technology. And the barriers to entry are so high that it is difficult to imagine anyone catching up. Let me explain what goes into an EUV machine so you can appreciate the complexity. UV lithography uses extreme ultraviolet light with a wavelength of just 13.5 nanometers to print patterns onto silicon wafers. This light is so easily absorbed that the entire process must happen in a vacuum. The light is generated by firing a laser at tiny droplets of molten tin, which produces plasma that emits EUV radiation. This happens 50,000 times per second with microscopic precision. The optical system that focuses this light uses mirrors rather than lenses. Because no known material is transparent to UV light, these mirrors are the smoothest surfaces ever created by humans. If the mirror were scaled up to the size of Germany, the largest imperfection would be less than a millimeter tall. The entire system contains over 100,000 parts sourced from hundreds of suppliers around the world. Many of these parts are available from only one source. The assembly and testing process takes months and requires extraordinary precision. Each machine costs over $300 million. Some of the most advanced machines, called high-NA UV systems, cost over $400 million. And even at these, ASML cannot make them fast enough to satisfy demand. Here is something remarkable. ASML spent over 2 decades and billions of dollars developing EUV technology before it was commercially viable. For years, critics said EUV would never work. that the technical challenges were insurmountable, ASML persisted because they understood that whoever solved EUV would own the future of semiconductor manufacturing. That persistence has been rewarded beyond anyone's expectations. ASML is now one of the most valuable companies in Europe. Their stock has compounded at over 20% annually for decades, and their monopoly position seems more secure than ever. Let me talk about the competitive dynamics, because this is important. You might wonder why Intel or Samsung or some well-funded startup does not just develop competing technology. The answer is that they have tried. Intel invested billions in EUV development before giving up and becoming an ASML customer. Multiple other companies attempted EUV development and failed. The technical challenges are genuinely that difficult. EUV requires expertise in laser physics, plasma physics, optical engineering, precision mechanics, and systems integration at levels that few organizations possess. ASML has spent decades assembling this expertise. Replicating it would take another organization decades, by which time ASML would have moved even further ahead. There are also network effects that strengthen ASML's position. Because ASML is the only EUV supplier, all EUV-related research and development happens on ASML platforms. When customers like Taiwan Semiconductor develop new manufacturing processes, they do so in collaboration with ASML. This learning feeds back into ASML's products, making them even better suited to customer needs. The ecosystem of suppliers, researchers, and engineers that has grown up around ASML represents another form of moat. Critical components come from suppliers who have invested heavily in meeting ASML's specifications. Researchers at universities and national labs collaborate with ASML on fundamental science. This ecosystem cannot be easily replicated. Let me discuss the growth trajectory, because I think investors underestimate how much runway ASML has. Current EUV machines are already in high demand, but ASML is developing the next generation called high numerical aperture or high NA EUV. These machines will enable even smaller transistor sizes and more complex chip designs. They cost significantly more than current EUV systems and will drive substantial revenue growth. Beyond EUV, ASML also sells deep ultraviolet lithography systems, metrology equipment, and other semiconductor manufacturing tools. Their installed base of over 10,000 systems generates recurring revenue from service contracts and upgrades. This business is highly profitable and provides stability alongside EUV growth. The secular trends driving demand are powerful and durable. AI requires more advanced chips. Smartphones and computers continue to need faster processors. Automotive electronics are proliferating. Industrial automation is accelerating. All of these trends require increasingly sophisticated semiconductors, which require ASML's equipment to manufacture. We expect ASML's revenue to grow at double-digit rates for at least the next decade. Their profit margins should remain high given their monopoly position. This combination of growth and profitability should drive substantial stock price appreciation over time. Now let me expand on ARM, because I think this is the company where investors most misunderstand the opportunity. ARM is not a typical technology company. They do not make products that consumers buy. They do not run services that people use directly. Instead, they license intellectual property that enables other companies to build chips. This business model is unusual, but it is extraordinarily powerful. Here is how it works in practice. ARM develops processor architectures, which are essentially the instruction sets and design templates that define how a processor works. Companies like Apple, Qualcomm, Samsung, and NVIDIA license these architectures, and use them to design their own chips. When those chips are manufactured and sold, ARM receives a royalty on each unit. This model has several profound advantages. First, ARM captures value from the entire semiconductor ecosystem without bearing the capital intensity of manufacturing. Building a chip factory costs tens of billions of dollars. Designing a chip requires thousands of engineers and years of work. ARM has already done the hard work of creating the architecture. Their customers bear the cost and risk of implementation. Second, ARM benefits regardless of who wins in any particular market. Apple and Qualcomm are fierce competitors in smartphone chips. Both use ARM architecture. ARM wins no matter which company sells more phones. This diversification reduces risk while maintaining exposure to overall market growth. Third, ARM's architecture has network effects that strengthen over time. Because so many companies have built on ARM, there is a massive ecosystem of software, tools, and expertise optimized for ARM chips. This ecosystem makes ARM more attractive to new customers, which strengthens the ecosystem further. It is a virtuous cycle that entrenches ARM's position. Let me talk about the mobile opportunity because this is the foundation of ARM's business. Virtually every smartphone in the world uses ARM-based processors. Apple's chips, Qualcomm's Snapdragon, Samsung's Exynos, MediaTek's Dimensity. All of these are based on ARM architecture. The few smartphones that do not use ARM are insignificant in market share. This dominance exists because ARM architecture is fundamentally better suited to mobile devices than the alternatives. Mobile devices need to balance performance with power consumption. Because they run on batteries, ARM's architecture was designed from the beginning with efficiency in mind, giving it a structural advantage in battery-powered applications. The smartphone market ships over 1 billion units annually, even at relatively low royalties per unit. This represents substantial revenue for ARM, and the royalties are increasing as smartphones become more sophisticated and incorporate more advanced ARM designs. Beyond phones, ARM dominates in tablets, wearables, smart speakers, and other consumer electronics. The Internet of Things represents billions of additional devices that need efficient processors. ARM is positioned to capture a significant share of this growing market. But the really exciting opportunity for ARM is in data centers. This is where growth is accelerating, and where I believe the biggest upside potential lies. For decades, data centers were dominated by Intel's x86 architecture. Servers ran on Intel Xeon processors, and companies like AMD competed on the same architecture. ARM was considered unsuitable for data center workloads that prioritized raw performance over power efficiency. That perception has changed dramatically over the past few years. Amazon Web Services developed custom ARM-based processors called Graviton for their data centers. They found that Graviton chips offered comparable performance to Intel at significantly lower cost and better energy efficiency. AWS customers have rapidly adopted Graviton instances, and Amazon is already on the 4th generation of these chips. Microsoft is developing custom ARM-based processors for Azure. Google is doing the same for their cloud infrastructure. These are not experiments. The biggest cloud providers in the world are betting their future data centers on ARM architecture. NVIDIA, the dominant player in AI chips, is also embracing ARM. Their Grace CPU designed for AI workloads uses ARM architecture. The combination of NVIDIA's GPU technology with ARM's efficient CPU architecture creates compelling solutions for AI data centers. This data center transition is still in early stages. The vast majority of servers still run on x86 architecture. But the direction is clear. New data center designs increasingly incorporate ARM-based processors, and the economics strongly favor continued adoption. 4 ARM data center chips carry much higher royalties than mobile chips. A smartphone processor might generate royalties of a few cents per unit. A data center processor can generate royalties of dollars per unit. As ARM's data center presence grows, average royalty per chip increases, driving revenue growth that exceeds unit growth. Let me also discuss ARM's opportunity in automotive, which is another high-growth area. Modern vehicles contain dozens of processors controlling everything from engine management to infotainment systems. As vehicles become more computerized, electric, and autonomous, the number and sophistication of these processors is increasing rapidly. ARM architecture is well suited to automotive applications because vehicles, like mobile devices, are power constrained. An electric car cannot afford to waste battery power on inefficient processors. ARM's efficiency advantage translates directly to longer driving range. Automotive chips also carry higher royalties than mobile chips. And the automotive market is transitioning to more sophisticated processors for advanced driver assistance systems and eventually autonomous driving. ARM is positioned to benefit from both volume growth and royalty growth in automotive. The company estimates their total addressable market in automotive will grow from $2 billion today to over $8 billion by 2030. If ARM maintains their market share, which seems likely given their entrenched position, automotive will become a meaningful contributor to overall growth. Let me bring this all together and explain why I am so confident in these 3 investments: Taiwan Semiconductor, ASML, and ARM represent essential infrastructure for the AI revolution. They are not competing for market share against well-funded rivals. They occupy structural positions in the technology supply chain that cannot be easily challenged. Taiwan Semiconductor's manufacturing monopoly is protected by decades of accumulated expertise and tens of billions of dollars in capital investment. ASML's equipment monopoly is protected by technology that no one else has been able to develop. ARM's architecture dominance is protected by ecosystem effects and switching costs that grow stronger over time. These moats are not temporary advantages that will be competed away. They are structural features of the semiconductor industry that have persisted for decades and show no signs of eroding. At the same time, all 3 companies are positioned to benefit from the most powerful demand driver in technology today, which is artificial intelligence. Every AI chip needs to be manufactured by Taiwan Semiconductor. That manufacturing requires equipment from ASML. An increasing share of AI chips use ARM architecture. The entire AI boom flows through these 3 choke points. The valuations are reasonable given the growth trajectories. Taiwan Semiconductor trades at a discount to its customers. ASML and ARM trade at premiums, but premiums that are justified by their monopoly positions and growth rates. None of these stocks are obviously cheap, but great businesses rarely are. The management teams are excellent across all 3 companies. They have demonstrated long-term thinking, disciplined capital allocation, and technological leadership over many years. They are not promotional or reckless. They execute consistently and communicate honestly. The balance sheets are strong. None of these companies face financial stress. They have the resources to continue investing in their competitive positions. They have the flexibility to navigate economic downturns without compromising their businesses, and the secular trends supporting demand are not going away. AI is not a fad. The build-out of AI infrastructure will take years and require massive investment. Even if there are pauses or setbacks along the way, The overall trajectory is clear. I have put substantial capital behind these convictions. These are not speculative positions I am taking with money I can afford to lose. These are core holdings that I expect to own for many years. I am betting my financial future on the continued success of these businesses. That is not a statement I make lightly. I have been investing for over 20 years. I have seen many technology cycles come and go. I have made good investments and bad investments through all of that experience. I have developed judgment about what makes a truly exceptional opportunity. These three stocks represent that kind of opportunity. They're the right businesses at the right time with the right competitive positions. They are exactly what I look for in long-term investments. The AI revolution is creating the investment opportunity of a generation. But most investors are looking in the wrong places. They are chasing AI application companies that face brutal competition. They are overpaying for hype and hope. They are ignoring the infrastructure companies that will actually capture most of the value. I am not making that mistake. I am focused on the essential infrastructure. I am invested in the monopolies and near monopolies that every AI company depends on. I am positioned to benefit from AI regardless of which applications succeed. That is why I have been quietly accumulating Taiwan Semiconductor, ASML, and ARM. That is why I'm sharing this analysis now. And that is why I believe these three stocks represent the best AI investment opportunity available today. Let me leave you with some final thoughts on how to think about these investments and how to approach building positions. First, understand that volatility is the price of admission for exceptional returns. These stocks will not go up in a straight line. There will be quarters where earnings disappoint. There will be periods where the market loses enthusiasm for technology stocks. There will be moments of panic where prices drop 20 or 30% for reasons that have nothing to do with the underlying businesses. If you cannot stomach that volatility, these investments are not for you. The returns I am projecting are only available to investors who can hold through difficult periods. If you sell during a correction, you will lock in losses and miss the recovery. The compounding only works if you stay invested. Second, do not try to time the market. I do not know if these stocks will be higher or lower next month. I do not know what the Federal Reserve will do or whether there will be a recession. What I do know is that over a 5 to 10 year period, these businesses will be dramatically more valuable than they are today. That long-term conviction is more important than short-term price movements. Third, use volatility to your advantage. When these stocks pull back significantly, add to your positions. The best returns in my investing career have come from buying great businesses during moments of fear. The fundamentals have not changed during these pullbacks. Only sentiment. Those who keep buying accumulate more shares at better prices. Fourth, be patient. The AI build-out will take years. The full value of these investments will not be realized. You need to think in terms of years, not months. If you need the money soon, you should not invest it in individual stocks at all. These are long-term positions for capital. You will not need for many years. Fifth, keep learning. The technology landscape is constantly evolving. New developments will affect these companies for better or worse. Stay informed about what is happening in AI, in semiconductors, in the broader technology industry. The more you understand, the more conviction you will have, and the easier it will be to hold through difficult periods. I have shared more in this analysis than I typically share publicly. I have explained not just what I am buying, but why I am buying it, how I think about the risks, and how these investments fit into a broader portfolio strategy. I have given you the same analysis that I use for my own investment decisions. What you do with this information is up to you. You can ignore it and continue doing what you have been doing. You can research these companies further and reach your own conclusions. You can start building positions and join me in what I believe will be an extraordinarily profitable journey. The AI revolution is happening with or without your participation. The infrastructure is being built. The value is being created. The only question is whether you position yourself to benefit from it. I know where I stand. I am invested in the essential infrastructure of the AI revolution. I own the monopolies that every AI company depends on. I am positioned for the biggest technology transition of my lifetime. The opportunity is in front of you. What you do next is your decision to make. But let me add one more important point before I close. The window for these kinds of opportunities does not stay open forever. When I bought into these companies, not as many people understood the AI infrastructure thesis. The stocks were less discovered, the opportunity was less obvious. As more investors recognize what I have been seeing, prices adjust. The easy gains get captured, and what remains requires more patience and conviction. I am not saying the opportunity is gone, far from it. I believe all three of these stocks will be substantially higher in 5 years than they are today. But the best time to build positions is before the crowd arrives, not after. Every day that passes, more investors are waking up to the importance of AI infrastructure. More analysts are writing about these companies, more capital is flowing into these stocks. The thesis is becoming consensus, which means the valuation advantage is eroding. This is not a reason to panic or to rush into positions recklessly. It is simply a reason to act with appropriate urgency. If you believe the thesis, if you understand the opportunity, there is no benefit to waiting. Start building positions now, add to them over time, and hold them for the long term. The investors who build real wealth are not the ones who are always waiting for better prices. They are the ones who recognize great opportunities and act on them decisively. They have the courage to invest when others are uncertain and the patience to hold when others lose faith. I have had the conviction to act. I have been building these positions for over a year while many investors were distracted by other opportunities or paralyzed by uncertainty. That conviction came from deep research, clear thinking, and honest assessment of both opportunities and risks. Now I have shared that research with you. I have explained the thesis in detail. I have addressed the risks honestly. I have shown you how these investments fit into a broader portfolio strategy. The information is in your hands. The AI infrastructure build-out is the investment opportunity of our lifetimes. The companies I have identified, Taiwan Semiconductor, ASML, and ARM, are positioned at the center of that opportunity. They have monopoly positions, growing end markets, strong management teams, and attractive valuations. This is not speculation. This is investing in essential infrastructure for an inevitable technology transition. The demand for their products is not hypothetical. It is showing up in contracts, backlogs, and financial results that exceed expectations quarter after quarter. I know what I own and why I own it. I am confident in the thesis and committed to the long term. These three stocks are the foundation of my AI investment strategy, and I believe they will remain that way for many years to come. The choice is now yours.